Good morning, everybody. Welcome to the Flow Show. Another day under the bridge. See what fun and games is going to be happening today. It's ECB day, so let's bring in the other two. Morning, Kay. Morning, Stel.
No, we're the other two now, are we? Good morning.
The other two of three.
The Three Stooges.
Did you say you have water under the fridge?
The what?
Did you say you have water under the fridge?
Oh, under the bridge.
Good morning, everybody.
Yes, the three wise monkeys are here again today. Set your world straight in trading. It's Thursday. It feels like we worked about 8 weeks this week. Let's get straight into it. Oh, I can't even find my notes now. Where have they gone? There they are. Right. I am knackered. China is still likely to cut its RRR following the cash injections, says the Shanghai Security News. They say the probability of RRR cuts still exist, but the probability of short-term interest rate cuts is still low. So looking at those MLF rates and MLF rates to be kept unchanged, but the sword of Damocles about reserve requirement ratio cuts still hanging over there. It's all going to depend on the economy in China and how it recovers. If it does recover strongly, those RRR cuts will be pushed further to the back of people's minds. Japan, we're still hanging around for all this wage stuff, and the Japanese Center for Economic Research, they estimate the wage hike, the 2023 wage hike, at around 3.05%. That's higher than a lot of were expecting at 2.85%. So a whole 20 pips up on that, which doesn't sound like a lot, but in Japanese terms, it is quite big. Kay, you anything more concrete yet on any of these wage deals? We're still watching and waiting.
No, I'm exactly where you are at. So it seems that I don't know how much they talk to each other, all those bosses and unions, but putting it just above the 3% mark. I don't know if it's going to change much if it really comes out there. I guess the market is already now assuming that it will be around this 3% mark. So let's see where the final results are, and then perhaps the market will take a bit of direction on the back of it and expectations for the Bank of Japan. But so far, it's rather trading risk. It's rather trading risk. The interesting thing, though, which I would like to mention, is that we are second half of March. We are in the final month of the Japanese fiscal year, and we could start to see some flows in the yen market appearing for people having to close their accounts or make the accounts, and we often see decent flows deriving from it. I haven't got a clue whether the importers will take the upper hand or the exporters. This year is really blind darts to know what those flows will be. But we'll have to keep a close eye on what's happening in the yen, what's happening in the yen, in the Nikkei, and the on the topics, and what's going on the Japanese yields front. So we are now in this last part of March, and usually, as I said, expect some flows to come into the yen market.
Yeah, agreed. Staying in Japan, and a bit of data out overnight. Machinery orders coming in fairly strong to kick off the year, 4.5% year on year, 9.5% month on month. The manufacturing side of the economy hasn't been looking too hot compared to services, but some decent numbers coming in there anyway. Trade balance data, which for me is just still all over the shop. Exports still coming in a pretty strong number, 6.5%. Imports also quite strong, not as much as expected in both counts, but still producing some decent numbers there. For me, the trade balance stuff it's going to take a while to settle down, I think, given everything that's gone on, virus and all the inflation and everything. So I'm not drawing too many conclusions there. Could we see a bit of a shift into the financial year end, Kay, on these numbers as well?
Well, I mean, they're not really they're not really attached to fiscal year end. I don't know. March is going to be whatever happens, a strange month. So when those numbers come out, I'm not even sure that more than an algo blip we should pay attention to it. Yeah, it could be affected by year end, but I think it's more it's a rolling thing, right? Exports, imports. It's not because you're at the end of the fiscal year that you're not going to import or export stuff. So I don't know. They may be a little bit distorted, but I don't have out of experience any recollection that March is a big distortion month for the trade balance. What we have to note, though, is that both imports and exports have slowed down. Exports actually higher than last month. But imports slowing down is normally not really showing a very high activity level locally. So it's not.
Yeah, I mean, the only reason I ask about that is because sometimes some countries, some firms, they can book a load of buying or selling just before the year end, financial year end, just to book it under those accounts rather than shift it onto the New Year's accounts, depending on what they want to do. But
it's possible. Like you say, yeah, I think then we have to look more at what's happening on the current account balance than really what's happening on the actual trade balance. I guess that's going to be probably more affected. But yeah, look especially what's happening in the next 2 weeks. I'd say in the bond and the equity market as well, and flows on the yen. I'll try to raise a couple of antennas to see if anyone is expecting anything spectacular. Yeah. But anyway, cool. Yeah, I don't think trade balance. I think more the current account might be affected by end of fiscal year.
Cool. Over to New Zealand and GDP coming in slightly softer than expected. On the quarter, down 0.6% versus the 0.2% prior. Year on year, down 2.2% versus the 3.3% expected. Again, this is a bit rear view mirror stuff because now we're just about to end Q1 and we're still reporting Q4 numbers, but the market's going to take it for what it is. There has been a bit of selling of the Kiwi by leverage funds since the GDP and over some of the other bits and pieces happening in New Zealand. They sold leverage funds were selling Kiwi also on the rumor that S&P might take a hit if its current account deficit remains too big, and they've been selling those funds for the last couple of days, it seems. So a bit of selling pressure on the Kiwi at the moment. Looking at the data from yesterday in the US, before we tick into the mess that is Credit Suisse and stuff today, retail sales coming in better than expected, but it's not wholesale good. If you look at the core sales, that's the control group, that came in pretty well, but retail sales headline number came in as a negative, just slightly worse than expected. Year on year, we're slightly worse as well. If you strip out the gas and autos, retail sales were flat, so it shows you a bit of what was driving those as well. PPI came out as well, and pretty much what we saw, or what we've been seeing in inflation, coming down lower and lower in pretty much all the counts there. 4.6% on the headline number, was expected at 5.4%, so a bigger drop than expected there. Empire State Manufacturing was another bit of a crater number, expected a -8, and it came in at -24.6. This one has been a bit volatile of late, so we have seen it a bit up and down. So maybe not drawing too many conclusions from that. We do have the Philly Fed today, the second manufacturing data of the month, so keep an eye out for that one to see if there's a bit of a trend going on in that one there. NBA mortgage apps were out early, and again, a bit of an uptick in applications. The rate coming off a touch from the prior rate. Likely as everything, all the fallout from last week and this week are going to be playing into these numbers probably. I wouldn't be surprised if that number comes in lower again next week, given the market's mood about Fed rates at the moment. But overall, taking it as a whole, this one's a bit messy. It's not giving any real clear signals right now for the housing market in the US. It was trending up beginning of the year. It then dipped a bit. It's now back up again. So I'm not drawing much from this one at the moment. Right, coming over to the mess that is Credit Suisse. What a funny day yesterday. So Credit Suisse were in trouble. The Swiss National Bank declined to comment early doors. The French finance minister declined to comment on the sharp declines in French stocks because of the Credit Suisse mess. The Bank of France declined to comment in the drop in French bank shares. Credit Suisse CEO came out and says that government assistance isn't a topic for the bank, and that the material weakness people are referring to is in financial reporting controls. They don't have an impact on financial results. He said, we are a strong bank and overshoot all regulatory requirements. Our liquidity base is strong. Says the situation in the US is not comparable and factually has nothing to do with Credit Suisse. Later on that day, according to the FT, they went screaming to the SNB and government asking for a show of support. And then the regulator, FINMA, and the Swiss National Bank came out with a 50 billion Swiss liquidity backstop. So much for government assistance isn't a topic for the bank, and that our liquidity base is strong. Obviously, that's what bank runs do to you, and when people cane your bonds and your CDSs and everything else. The SNB, so they offered this 50 billion liquidity backstop, and the statement said there's no indications of a direct risk of contagion for Swiss institutions due to the current turmoil in the US banking market.
Did they really have to say that? When you deny something, it's the last straw, right? When just before it happens. So that makes me very nervous.
Well, it was a strange situation all day because no one stepped up from the government or the SNB. Likely because they spending their time on the phone wondering how big a pile of shit they were dealing with. But it's not as if they didn't sort of act like the Fed and come rushing out really quickly and the Treasury to say, we're on top of it. We're making our moves. We're putting the backstops in. It all seemed to be a bit half-hearted, a bit delayed, a bit non-fussed about it all.
You know why, right? Because the best case scenario is for confidence to come back without any intervention. So basically, we've had the situation now with Credit Suisse for many reasons I'm guessing, but the main problem was that I'm sure that there were many of the clients pulling their funds like there's no tomorrow. And I heard of a certain ship owner here in Greece who pulled 100 million, just like that. So I'm sure there's many organizations and people who got scared and got their money out. And what they want ideally is an orderly return of confidence without an intervention. That's what they're going to try and get. Obviously, they couldn't get it yesterday. So at the end, even though they were saying, our liquidity is great and all that, I mean, it can't change within an hour, right, or two. So they're trying to do that. And when it fails, they go to daddy and say, please help.
It's a bit of a damned if you do, damned if you don't. If the SNB regulators don't say anything because they, to try and give the impression there's nothing wrong, the market panics and says there must be something wrong because they're not saying anything. And yet if they do act, the market says, well, you're acting because there's something wrong. So you can't. I have no sympathy for them, but in that situation you can't really win, can you? But
It's what exactly right, and it's what I said yesterday. You know, when there's smoke, there's fire, and you can't get away from that. And you know, do I think the situation is contained? No. We don't have any proof of that yet. You know, all we have is an American bank failing, a big Swiss bank getting effectively government backstop, and other European banks being their stocks suffering, and you have banks like Deutsche and BNP or whoever else. I mean, they are huge. You really don't want to have trouble in those banks. You know, those banks are essentially the country, right? The government. So, do I think it's contained? No.
Yeah, I was surprised we didn't hear more about fingers being pointed at Deutsche Bank. They must have been sitting in a dark corner, hoping everyone ignores them. Because people need to understand. Okay, Credit Suisse has a reputation at the moment. Not a good reputation. They have a reputation for bad trades, bad investments. Usually, if there's something gone wrong in some financial market somewhere, you can bet your bottom dollar they've got exposure to it. It's the way they've been for several years now. I mean, on Friday when the US banking stuff first started, I think I put in the chat room, I wonder how much exposure Credit Suisse has to it. That's the reputation they have. And so someone or someones have taken a pot shot at Credit Suisse because it's the path of least resistance if you want to try and force another bank into problems. But now it looks like we may be over the worst, touch wood, unless there's any further fallouts that we don't know about. And it's quite surprising how quickly this is all getting resolved, which is how it should be, shouldn't it? Because this is what regulators and central banks have been building all these tools for the last decade, for these sort of problems. So is it a surprise that we could be over this sort of thing pretty quickly, like we were in the UK with the pension fund stuff?
Well, are we over it? That's the thing. I don't think. I know
I'm not saying we're all the way through the other side, but the very worst of it.
Potentially, yes. Potentially, I'd be. I'm always a little bit concerned when I see situations like this, and it's been many years that we haven't seen a situation like this. And I remember 2008 very, very well how it started. So excuse me for being a little bit cautious.
Many years. It was 6 months ago, mate, with the UK pension stuff.
That's true.
Anyway, Kay, what are your thoughts on it? Are we over the worst, at least today?
Too early to tell, but I understand the silence yesterday, as I was also saying in the room, and sometimes not intervening too fast is a soothing factor for markets as well, but not specifically yesterday. But I think too early declarations of anything would have perhaps done worse than good. Because that's saying to the market, oh yeah, this is it's panic stations everywhere. So I think it's okay that they took hours to react. They didn't take several days, right? They took hours to react. So that's. But are we over the worst? I don't know. But if I read the numbers, let's put it that way. If I look at articles who produce the numbers without and stripping out the noise, of they are going down under, or there's nothing wrong. If you strip out all of that, the numbers say that they are still well capitalized because they are also, or they should at least respect the levels of reserves that the BIS put in place. I think it's BIS 2 or 3 or whatever, which came out after the crisis. So yeah, I don't know. I think okay. SVB to me was more a storm in a glass of water than Credit Suisse. Credit Suisse is bigger because of all the ramifications, and we have seen yesterday, as you already said, European bank stocks getting hit very hard because they probably have a lot of exposure, even though they all came back saying like, oh no, we reduced exposure, and the US reduced exposure. Spanish officials came out saying that they have less than 1 billion, their banks, Spanish banks have less than 1 billion exposure to Credit Suisse. So could the worst be over? Yes. Is it completely over? Too early to tell, I'd say. But we have seen, if you look at how the markets react, it's pretty much like I said in the room. That you had like those two reasons why the Swiss franc, for instance, strengthened. It's first of all risk off, everybody piles into Swiss franc, and then secondly, those what I said, they might have had to repatriate some funds as well to cope with all the withdrawals. So that was the impact on the Swiss franc. But then, if you look at it in a second part or third part, is that all right? I mean, there's still problems for a Swiss bank. So and then the market pretty quickly turned around, and we closed the day much higher in Euro Swiss, for instance, than where we started it. So or about where we started it. Yeah, so the worst may be over, but I think if you look at the currency, the worst for the Swiss franc may not be over.
Yeah.
That's my view on it.
Yeah, well, I'm going to say the worst is over in terms of CS for now. I think throughout the whole of yesterday, I could not find a reason, see a reason, get given a reason why they were under attack, like a specific reason. If they'd have turned around and said they had, $1 billion or $2 billion exposure to SVB and US banks or something like that, fine, you've got a definitive reason. I think this was really just an attack on one of the weak links in the European banking sector. Always is going to be a target, whether UBS buy them or not, always comes around. I think this was just purely an attack on one of the weakest links. Does it mean there's not going to be further fallout? Absolutely not. But I don't see them going to the wall. At the very worst, it might hasten an actual sale or someone coming in and buying them up. Because you can bet your bottom dollar, if they did go pop yesterday, there would be a queue as long as you're armed of banks stepping into hoover up the bits and pieces. So yeah, that was my thought, and that was one of my reasons I've traded euro dollar that way yesterday, which we'll talk about when we look at the prices in a moment. Just looking at some of the other stuff and just sticking to credits. Yeah, go on, mate.
Yeah, well, yeah, okay. I don't know if you I didn't know whether you were going to move on. Just one thing why I'm now looking at probably sell Swiss franc on a decent rally is that the result of all this, I can see more regulations, meaning more or less opacity in the Swiss banking system again, and we know why the Switzerland is such a big parking place for wealth and global, yeah, from the whole world for wealth, because there's still that more opacity in their system than in other countries. And one of the fallouts of this whole thing is that there could be some more regulations coming in, and if wealth managers or if big money, well, call it wherever it comes from, they might not really like it, and then we could see some more Swiss franc weakness. But that's something that when it gets confirmed, if it gets confirmed, then I think that may weigh a little bit on the Swiss franc. But that's why I'm also saying the whole story may not be over. Yeah,
absolutely. And on that front, it was said, it had been reported yesterday that some of the US's biggest banks were cutting exposure to Credit Suisse for prior months. Whether they smelt something coming, who knows? The only ones who know are the ones who are on the inside. But that has been a story reported yesterday that a lot of exposure was cut in Credit Suisse. Coming over to the ECB, and obviously it's ECB day today, which we'll get stuck into. Former VP Vitor Constancio said the ECB should hike by 25 pips at most this week. Today, it's really a bit of a coin flip for rate expectations. It really is literally 50-50 whether they go a 50 or a 25 today. Very little real expectation for a complete pause, but it's still a risk we need to look at as well. But again, we'll talk about that in a moment. Looking at the Fed, and the rate expectations have really been all over the shop there as well, well, across the board. And partly a lot of that is because the prices are so volatile in them that are used for these models and these rate expectations. It is a little bit jumpy, and perhaps we can't take them with too much strength. So you have to take them for what they are, a bit of a pinch of salt. But at one point yesterday, the Fed swaps were pricing 100 basis points of cuts by the end of this year. The BOE traders were pricing in no hike at the next meeting, but interest rate futures had it as a 50% chance that they wouldn't raise at the next meeting. Today that sits at 54% for unchanged, 46% for 25. Fed currently pricing a 67% chance of a 25 pip hike and a 33% chance of unchanged. And again, what happened today in ECB, I think, is going to be a bit of a yardstick for what the market expects the Fed to do. So my expectations for the ECB today, I'm 60-40 on the fact that they will go a 50 pip hike. I think there is a higher chance that they may go 25, purely because they want to be showing the market that they're in control of things. I think a complete pause would be a bit of a shock move. So I'll give that a very low possibility. But yeah, I think a 50, but obviously strong talk about what's happening in the banking sector and how they're monitoring it. And also they'll likely point to the fact that they have got tools in place to use for these kinds of situations. As I said, they've been building these since Lehman's, the banking crisis in Europe, GFC, all that sort of stuff, for these very events. So if these tools are up to the task, they're going to pull them out their hat and use them. And that should mean that they don't have to use monetary policy for these types of problems. So I expect them to probably go a 50, speak a lot about these issues, speak a lot about the fact they've got it covered, and that monetary policy doesn't need to be potentially a tool against these sort of problems. They can carry on with policy whilst using their other tools to provide liquidity if needed. So for euro dollar, and just to quickly answer Michael's question, he's asking why I've got duplicated charts. Pure and simple, I've got charts that I use mainly for trading that have all my levels on, and then what I also like to do, as you can see there, it's all nice and colorful. What I also like to do is keep charts with very little on, just to give me a nice clean view of things. So I'll often have charts that have very little tech on, or just highlight the important things, just to give me a bit of a different picture, bit of a cleaner picture. So that's why I run 2 lots of those. And I'm a bit lazy, and I can not tidy up my charts as often as I probably should do. So they do tend to get a bit messy, and I like to see the wood for the trees. But in terms of the euro, so pretty much we're sitting in this box that we're watching. I've been quite surprised. I mentioned it the other day, the fact that the volatility has been fairly low in the euro dollar. Yes, it's moved around. Yes, it's jumped around, but no way near as much as we've seen in some of the other pairs. You can see it here, this area, this 105s, 107s. We've had a bit of extension up to the next area, 107.60s. We all know that 108s is another big zone to look at. We're pretty much bang in the middle of the zone at the moment. We had a look at the 105s yesterday. I picked up some longs down there. Didn't get quite down to that close 105s that I'd like to. But I was happy again to trade the fact that Credit Suisse wasn't going to end the financial universe. So I jumped into that. It's 50-50 where it goes from here. I think if the ECB goes a 25, we should probably see that come off some, because it would be confirmation that they are slowing. I maybe wouldn't expect it to get all the way back down to these lows, but we could well get down to maybe 105.5, something like that. If they pause, that will bring a bigger negative reaction, in my opinion, because it would be a bit of an extreme move. In that case, we may well get down back to these lows again. I don't think we would see 105 get taken out. If it couldn't get taken out amid the banking crisis yesterday, I can't see it being taken out on the ECB reacting to that banking crisis. And any pause or lower rate hike today is not a direct consequence of inflation or the data. Inflation's still there. Inflation's still sticky. They are still wary about it. This would be purely a financial stability move. And then the market would expect them to continue hiking, even if they hiked at a slower pace for longer, until such time as we're over this hump. So I don't see any material reason why the euro should really suffer on them going to 25 or pausing. If they go a 50, however, I can well see this getting back to 107. If it's a complete business as usual as far as monetary policy goes for it, trying to get inflation under control, I would not be surprised if we maybe even hit those highs, maybe even have a look at the very least or very most up at the 108s. So I'm sitting in longs at the moment. If I've got a decent bit of margin in it, I'm happy to let that ride over the ECB and look to pick up any dips going down into 105s. Guys, what are you got any thoughts for ECB today?
Well, yeah, we have to ask ourselves one question. Do we think yesterday the various European banks have been on the phone to the ECB? Because I'm sure the ECB will want to know the situation. I think that that Credit Suisse was not the only bank on the phone to regulators and central banks. And I think that the situation is still very delicate. Monetary policy will not solve any problem for the banks, of course. So 25 or 50 will make absolutely no difference in terms of monetary conditions. However, it will make a huge difference in terms of confidence. And I've been saying this for a few days. I still think they're going to go 25 just to try to appease the crowd and smooth the environment, a little bit. So I wouldn't be surprised if they actually pause. But I think that's an extreme reaction. I don't think they want to show that, but they can easily do something like a hawkish 25. So, hike 25 and say, look, we're still looking at inflation, of course, but we're also sensitive to the financial environment, blah, blah, blah. And they could do it this way. So I think it's going to be a 25. They could do 50. If they do 50, even though it really makes no difference to the banks, I think the market's really not going to like it. And I think the ECB knows that. So that's why I think they're going to go 25.
Yeah. And I will buy you lunch if ever I see blah, blah, blah in an ECB statement.
Imagine. Wait until Stornaras becomes the chairman, the Greek guy. Then
there'll be lots of blah, blah, blah. Yeah. Kay, what are your thoughts?
Well, in the room this morning,
you covered every base.
Yeah, I found like 7 or 8 different possible scenarios, and I might not have found all of them. But yeah, I'm also somewhere between 25 and 50. It's either going to be a dovish 50 or a hawkish 25. But then there's always the trump card, right? About asset program. And that may be somewhere where they tweak. And that's also my idea for next week, the Fed, actually, that they may do something about not continue to tighten financial conditions too much right now. So they may just keep the monetary policy on the path. And I think it's kind of what the market is trading right now as well, right? If you see euro sterling, euro crosses are moving back up. So yeah, I'm anywhere in between 25 and 50. I'm not going to say I'm 100% confidence with this or that one, and then see what Lagarde does to mess it all up in the press conference. But I agree with Stelios that, and I've also said that in the room. Don't forget that Lagarde is French, and the two banks who got hammered the most yesterday, at least where the most noise was made about, was BNP and SocGen. So her being French, I'm not going to rule out that she would take some of it into account. But yeah, and as you say, I think if unless they go really gung ho and like, oh no, this is bad, we don't raise, and we don't know about the future path either because of the banking situation, then your euro dollar is going to collapse. But if that is ruled out, then I think euro may be a buy on dips, as you said, Ryan. The big level, yeah, you were showing the low 105s, but there's a big zone, 104.60.80 that I'm watching.
Got
It's
that
the
dip
prior
down there.
low and what is it, 61.8 or so of the move up from 95 up to 110. And that is to me going to be the big test zone. And I'm more than willing in current conditions to try and catch a knife. I was waiting for it actually to be tested yesterday, on the big drop and the big panic in euro. I was like waiting for that level, and I would have tried to catch a knife, but it didn't go that low, which supports your view that euro is probably like 80% chance that it's going to be a buy on dips.
Yeah, no, you're quite right. And I think the only thing that might be slightly concerning is we do keep making a lower low each time. And I've been talking about this yesterday. I spoke about this in the room this morning as well, about, people who want to look for tops and bottoms, and giving yourself a reason why you need to look for the signals. So I still wouldn't rule out a test this 105. It is going to be a bit of a zone from there, down to that 38.2 fib, which was also a prior support and resistance area, 104.5, that sort of area. So, may not be one line. We may get a decent break under here, 105, 104.90, but then that's where it may run into trouble. And you've got to look at the volatility in this pair as well. The volatility is pretty well contained given everything that's gone on the last few days. Euro sterling, this one I managed to mess up completely yesterday. I jumped in at the 87.40s just for a little bit of a pickup. That soon got taken to the woodshed. And then I was trying to be a dick for a tick down here into this area that I've been watching for bloody ages. And then I didn't get anything on. And here we are sailing back above 88 again. So kicking myself a bit for that one, but we can't trade backwards. So have to move on up. I am going to be looking at this one as well to add to my core longs. If we get a move down here on the ECB, maybe going on pause, I think that may be a bit far-fetched to see us back down there again. But you never know. You never know. Dollar yen quickly, and then I'll pass it over to Kay. What's standing out for me in dollar yen is that the recoveries aren't really holding that strong. Talking about picking the bottoms, we had this banking low on Monday, the US banking low. We made a new low yesterday on the Credit Suisse stuff, only by 6 pips. But for me, the optics of that say that, maybe it's not as strong on this low as it could be. If we'd have stopped somewhere around here, 132.50 on this low, then we would have had a stepping up. Now I've got a bit of confidence that, a bottom may be developing here. It still might be, but I don't like it when a let's call it an event low gets taken out again. It suggests that the market isn't ready to find a proper bottom, and there is still a chance that we could head lower. And as I say, the bounces so far aren't looking too hot off this low. So, we've come down. We're a bit middling at the moment. I think it's 50-50 here. I think a lot of the market is going to be waiting, as I said, what the ECB does, and then they're going to extrapolate that across to the Fed. So if the ECB go on pause, the market's probably going to cement a pause from the Fed. And then obviously we're going to see more changes in rate expectations because we're 67% pricing a 25 pip hike. So if that flips, we're likely to see yields come down again, and probably dollar yen maybe going through these lows and heading a bit lower. So really, it's a strange situation to be in, where the fate of the dollar rests potentially in the hands of the ECB. Kay.
Yeah, well, actually, you made an absolutely great point there, because I was saying this morning as well in the room. What's left if the dust and when the dust will settle, what's left is actually slightly negative data in the US, and that's why I'm a little I'm not going to say surprised, because I think stuff like cable, for instance, is more driven by euro sterling than actually cable itself right now. But I can take over the screen for just a couple of minutes. I'm not going to go over too much stuff, but there's a couple of interesting things to watch, and to a couple of instruments that maybe really big movers come post ECB, perhaps even into the Fed and stuff. So first of all, I'm going to have a quick peek at what happened yesterday in this Euro Swiss, right? So we had this double dip, SVB, then Credit Suisse, but worth noting that we held the November low, and we haven't gone to test the 61.8, which is just below 97. That means to me that yesterday somebody woke up and said, like, hey, hang on, this is perhaps not really great for what's happening in Switzerland. So that to me is telling. So this zone to me here, 97.10 down to 96.60 in Euro Swiss, is going to be extremely important if ever we retest that. I'm also thinking in the back of my mind that we saw a bit of SMB activity in there, because we know they are both sides of the market right now. I guess they were here on moves back up above parity, and I am going to take a wild guess that they were there yesterday as well to support the markets. And they are trading more actively than most of the long-term traders. So I really think we can't rule it out they were there yesterday. But also it does come in line with my thought about phase 1, 2, and 3 of what's happening in Swiss franc. I think two interesting things to look at is gold in this environment. We've seen when SVB started to quiet down, we've seen this is the episode of last week, right? And then we've seen when SVB was quieting down, the regional banks were quieting down, immediately gold came back off. Credit Suisse came up, bang, we really shot up again. So this one is now exactly what the market is going to trade. The speculators are going to trade, and I'm calling it speculators because I don't know whether there's real funds in there, but I do think there are. But what is going to be traded if there's crap happening everywhere else? So keep an eye on that one. I'd say, well, your first hinge is going to be the 1900, but I think keep a close eye on what's happening around 1880 if it goes back down there, and if the market thinks that we are not out of the woods yet, that may be a springboard to try and retest those latest 1960s highs. And then the other one, silver, that spiked. I have this zone here around 22, call it 22 and a quarter on silver. That spiked and came back down, and I think the reason why gold is outperforming silver is that when there's trouble everywhere, silver being commercial or manufacturing or industrial, that's the word I was looking for. Metal, if there's crap everywhere around, this is going to underperform. But if we see the yields staying low, if we see that actually the real economy is not going to be more affected than what it is right now, then I'm going to be reloading this stuff on any blip down in 21. So I'm going to really watch very closely what is happening in silver, in the economic, the real economic data going forward from here. I'm sorry, but Tulin, I'm not watching platinum, but I think it's the same, a bit the same thing as which was happening. That I think platinum could be like in the same line, or perhaps a bit more speculative than silver, perhaps. On the dollar Swiss, Bran, I'm going to have a quick look at it. You know, I'm not trading this, right? I mean, if I trade something, it's going to be crosses in Swiss. But I think in normal times, the dollar Swiss is just a euro dollar, really. But here, I think I know that some people were looking at this 93, 15, 20 yesterday. It's back down, but it's so uncertain what is going to happen on the Swiss right here and now and in the upcoming sessions, that I'm gladly going to leave that alone. If yesterday's US data wouldn't have been bad, I would have bought this yesterday. And I know people trade it the other way around because of risk, but with what's happening in Switzerland, if I'm going to, and I know I'm against most of you guys, but if knowing what's happening in Switzerland and thinking what my line of thought is, if the US numbers wouldn't have been bad, this one would gone spike again up here, I think. Now we've broken this trend line here. As long as we're below in the more medium term, 94 and a half, 94 3/4, that's the zone you wanna really look at. And in the meantime, you're here, 93 15, 92 90, 95. That's where you look at it. But I want to look at a bit of other stuff. As I said, euro dollar, to me, this is the biggest zone here. Interestingly, is that it held a short support line here yesterday around 105.10. So that's what Ryan already showed. 105, low 105 is going to be important today. And on the other side, we will be starting to look at 106.80 figure, and above there, big zone 107.5, 107.65, 70. That's going to be a big zone here. If that succeeds to break today, then we're off to the races again, in my opinion. Cable, a bit of a strange one. I bought this yesterday, already managed some stuff around, which I'm happy about. But this looks like a bit of a channel now, right? And we've also heard that there were decent offers around there, which has been confirmed, 122. Yesterday, couldn't hold the 121.40 in all the uncertainty. So that is going to be a decent marker on the top side once more. And then we're trading around this 120.70 really. If we are below, the 120.10 comes in supported. There's a very interesting zone to me. I know we've been through it a couple of times, but I still want to have a close look at what would happen if it gets back down in the 119.5, 119.75 zone at any time. But that's, in my opinion, going to be more the dollar telling us, or what's happening in euro sterling perhaps, than the sterling side. But in the meantime, 120.10.15, 121.40, that's going to be the range I'm observing going forward. And then with keeping like this bigger one in mind, with 120.10 here, it's already good enough, it seems. Now, and I'm not going to take much more time, but I want to look at at this one. So we had this break on the Aussie Kiwi below here, and yesterday, and many of us were long, and some of us got hosed here because we went through the prior low and unfortunately got stopped out. But then at the end of the day, I was looking at this and I was like, oh, hang on a bit. Perhaps I'm going to keep it down to there. I had a stop loss in place, which I think got saved by half of people so at some stage. And then came the double whammy out. Worse than expected Kiwi data and better than expected Aussie jobs report, and we raced back through this downside wedge, where the top side is about 107.40, and we're back already above that zone that I was watching before. So I got a bit of a lucky shot on my longs. Managed it already a little bit, but I'm going to be very tempted if ever we get a retest of this 107, call it 30, 40 zone, and then starting to watch again those previous lows or even the 107, the figure. So that for the Aussie Kiwi. The rest, if I think I saw something, somebody else was trying to, let me go back onto the questions. Gold. Michael, I'm absolutely no interest in Bitcoin, but we spoke a little bit about gold. Euromex, yeah, we can look at it. It's the issue with Euromex now, Michael, is the ECB today and the fickleness of the markets, and we're seeing this Euromex really trying to push back against those resistances here, 2035 perhaps than the previous highs. But to me, really, this one here, from where we started that last sharp move lower, that's the one that should be monitored. If you put a trend line here, I don't think it's worth too much, although the body of the candle stopped there as well. So perhaps here already in this zone, but it's very trading before the ECB is a bit of a risky one. On the underside, I think we need to now get back below and stay below. Not only get back below, but stay below this one here, 1990. If it goes below and stays below, then I think the whole panic story is over. On the dollar mix, we are seeing a bit similar situation, right? Spike higher, panic, whatever, but we haven't reached yet we're trading around here, are we? Yeah, around 1910, we're trading around here. But again here, this one here, 1928, 1926, 28, that may be where, if we break above, the panic is really there and we are going back to closer to 20. But as long as we're staying below there, the panic may just subside and get back below 1885, 90. We may have a look lower again, but for the time being, it's a bit of a hot potato, this emerging market. If the market quiets down, and we are going to need some decent economic data to support that. If the market quiets down, then we are going to see EM coming back. Dollar rand quickly, as we have been speaking about many times, low 18s, that's where it holds and that's where it bounces from. I don't think there's much more to look at. Top side 1845, 1850 for the time being, so you've got about 50 big figures to play inside. If we get above 1850, 55 again, I think there's a room to go and see the 1870s again, and then see what happens there. See this one, the prior highs. For the time being, the market is hesitant to take them out, so I guess we are in a bit of a range. And that's it for me. Back to you, Ryan.
Thank you, mate. Still, did you want to have a look at platinum or anything? If you got it,
not really. I haven't traded platinum in a little while. I mean, the big picture for me, platinum is worse than silver in terms of its correlation with economic activity, because silver, it's been used as a monetary metal. People hoard coins and bars and stuff. Not the same with platinum, at least not in the same magnitude. So if you're trading platinum, you are trading the economy a lot more than you are trading with silver, and that's why I always prefer to be on silver. Unless I see massive underperformance in the platinum silver ratio or something like that, then I'll have a look at platinum. But I always prefer silver. And if you look at the chart of platinum, I mean, I can actually, let me show it. Hold on.
Yeah, I don't think I even got it.
Don't worry.
And if you can look, because I forgot to cover it, but I mean,
No problem.
I think we're in the broad interesting zone as well, 62, 63.
Yeah, I was going to look at oil as well.
Yeah, I mean, we're in a big zone there, right? And we can't forget the SPR buyers as well. Please proceed, Mr. Stelios.
Yeah, but so talking about platinum, we're in a very similar. I mean, if you look at the silver, it's the same kind of descending channel, which is corrective after this big move from the COVID lows to the 2021 highs, but it's been correcting for a long time. Right, and this is why, because the Fed has been raising rates, the dollar's been rallying, and if you look at it, maybe platinum less so, but gold and silver, if you take a step back and look at how they've performed over the past couple of years, they've done pretty well. I mean, especially gold, given what the Fed has been doing with the rates and the hikes and the tightening. I mean, it's held up really, really well. So imagine what happens when they go into pause or even cutting. It just goes out completely to the highs. But platinum, it's a difficult situation here because we're in no man's land. If you ask me what I want to do with it, well, I would prefer to buy it, but I'm not as sure, let's say, or confident as I am with gold and silver. So yeah,
thanks, mate.
Just a quick look, and we're on it's worth noting we're on confidence support. So we have the 200 DMA and the 50% fib of that big move lower. So you could say that we are at support, but it's a bit tricky.
Yeah.
Anyway,
cool.
I'll give it back to you.
Last couple of things before we shut up for the day. I did want to have a look at oil. I know Ali was asking about that. Can you see my screen? I hope so.
Yes, we can.
Good. So we had a bit of a break of this zone down here, and even the 70 zone, a bit of a carve up. This zone has been, making a bit of a box, 82.50 down to these low 70s. We went through that. We went through the prior low at 70. We went through the 50 fib of this whole move from here. So a bit of a weak looking picture for oil. It's the lack of bounce is the worrying part for me from here. We are in a bit of support, as Kay pointed out. It gets chunky from here down to the 62, 61s. So it's making a bit of a fist here at this low area around the low 60s. So that's your marker for now. If we hold that again on a test, that's going to suggest maybe a bit of a bottom in place. How it reacts if we bounce up to these broken levels is what you're going to need to be looking at. If we get up there, can't get through it, then maybe we're going to set up another little mini range going on for the next few sessions ahead. And finally, keep an eye on those yields for the US. 1 year is still looking weak below the Fed midpoint. So this is below where the Fed rates are at the moment. This is my sort of sentiment marker for where the market is thinking the Fed will be going. If the Fed are going to stay on their track, we should expect this to recover above. So this is going to be the driver for Fed expectations, is going to play out in these sort of yields. So keep an eye on those for the rest of the data and what happens with the ECB. And on that note, another packed show. Hope we're doing you right this week with all our analysis and views. Thank you, as always, to the wonderful Kay and Stelios for their inputs. And thank you, as always,
so
to
the wonderful K and just plain Stelios. Okay, I
get it. The wonderful K and the Greek Stelios.
I'm just saving words. And
cheers,
obviously
man.
to the viewers for coming here and making this show worthwhile. Have a great day ahead. Have a great ECB. We shall see you tomorrow.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.